According to asset manager RECM, a flight to safety has pushed up the prices of typically low-risk asset classes to unsustainable level, and they caution that these lofty valuations may lead to capital losses in the future. RECM has been exploiting the negative sentiment around higher-risk asset classes like equities by buying large global companies. Now, joining us from Cape Town to tell us more is Linda Eads from RECM. An interesting point there, Linda, about low-risk investment classes becoming high risk because they're so popular.
Absolutely. I mean, it's all got to do with the perception of safety. And when many investors regard a particular asset class or a stock for that matter as being safe and prices are driven to expensive levels as a result, the irony is that that investment actually ends up being risky.
So Linda, where are RECM seeing the biggest dislocations in terms of price? We know in the article that you alluded to, European equities as being very unfashionable and considered to be risky in a different form of risk because of the sovereign debt crisis there. Where are some of the places that you've been picking up bargains?
Well, you know, the theme extends to particular stocks which are popular. It also extends to asset classes. So I'll give you a good example. You spoke about the European equity markets. If you compare European equities versus European bonds, or even local equities to local bonds, bonds are usually regarded as the low risk asset class. And the reason for that is they tend to be less volatile over time. But this quest for safety, for safer or more certain, if you like, investments has driven investors into bonds locally and globally. And what that's done is it's driven yields to all-time lows and prices to, in inverse, all-time highs, which means that bonds are actually a very unsafe place to be today, we feel. And the opportunity is really where the value lies. And value has got more to do with price, where prices are cheap, and European equities are an obvious starting point, but locally it really is a story of cyclicals, which are very cheap, versus defensives, which are more expensive.
Linda, in your piece, and I think these things are often best illustrated by a good hot example, like you say, currently investors are lending money to the German government for the next 10 years at a record low rate of 1.39%. They're after what is perceived to be the safest investment in Europe. But then you say yields could rise significantly, prices could fall, and it's irrespective of whether they default, but there's a significant risk of losing money.
That's right. You know, when there's uncertainty, and of course when you have a market such as the European market itself, looking at equities, there is uncertainty in the short term. But when you're investing, you're dealing with the future, and there's always going to be uncertainty with the future. And the only way you can really protect yourself is to pay a low enough price for whatever asset you're investing in. With bonds, for instance, what the article is suggesting is that the yield you're getting is very low, and in actual fact, there's a lot of risk of capital loss. And that's the risk we feel investors should be most concerned about. So in Europe, for instance, one of our European equities is Carrefour. It's the second largest retailer in the world. You can imagine that retail is very much out of favor at the moment, given the uncertainty with regards to the global cycle. Locally, we're invested in platinum stocks, and we've stayed away from the defensive, such as the retailers, and defensive, such as Tiger Brands, which are fantastic companies, but unfortunately very expensive.
So, Linda, we just wanted to make the distinction here between the intrinsic value and Carrefour is obviously a European-based retailer. Tell us a little bit about its intrinsic value, because obviously if you're exposed to the consumer in Europe, whose intrinsic value seems to be declining every day, if you believe all the reports in the news, that wouldn't make sense to be investing there. But is Carrefour a business that perhaps has exposure to other areas of the world where economic growth is strong and the consumer is still spending money?
Yes, well, to answer your last question, it does have exposure to other areas. But what we tend to do is try to look through the cycle. So a business like that, which might be undergoing some short-term pressure, what we do is we look at the history of that company and what returns it's been able to deliver to investors over and above the cost of capital. In other words, what is the quality of this business? And if we look through the cycle, what are the more sort of normalized earnings, normalized revenue numbers that you can expect for this business? Another point to mention, you mentioned economic growth. There is a little bit of a misperception that to get good investment returns, you've got to invest where the economic growth is going to be best. That's actually not altogether true, and an obvious example is South Africa. I mean, over the last decade, we've had fairly pedestrian economic growth, in fact, but we've been one of the best investment destinations globally. China has had fantastic economic growth, and yet it's been one of the poorer investment returns. So what it's all about is the price you pay. Is there more potential upside or downside? And if you pay a low enough price, if everything goes as you expect, then there's much more upside. Whereas if things go bad, you're already paying a very cheap price, and that downside is very much limited.
Linda, you mentioned Carrefour, and looking at your top holdings, that is your top holding, 7% there is the list there. Now, that's a French retailer, and looking at the French, the PMI in France is the lowest in the Eurozone, around about 44. A couple of days ago, they had their new car sales, 19% down, and French cars, something like 26, 27% down. So give us the context for your enthusiasm for Carrefour.
Again, it's really about the price you're paying for that business. So yes, all the things you're mentioning are correct, but what is the price you're paying? The price you're paying for Carrefour today suggests that you are buying their property book alone and you're getting the entire retail business or the going concern for free. That's how low the price is. So what you're in fact saying is that a lot of that negative news in the short term is already priced into the share price today. And in actual fact, the long-term upward potential is great, and that's where we look for absolute value. The reality is, if you want to invest in the absolute value space, which does the best job of generating real returns and protecting against downside risk, then you've got to buy quality businesses when they're out of favor. Unfortunately, they just don't become cheap in absolute terms when things are going well.
Linda, just to add to that discussion, obviously two of the biggest holdings in the fund, the RECM Global Flexible Fund, is Amplats and Anglo American. And I just wanted to understand that we have many fund managers telling us that Anglo American's trading at the lowest level, lowest book value it has in almost 50 years. Do you have to invest with a catalyst in mind to change that around, whether it be China's resumption of economic growth, or it's a new CEO that comes to Anglo American and starts to right the ship in terms of some of the investments they've made in the past? Or do you just take faith that the cycle will eventually turn? So the question is, really, does there need to be catalysts, or do you need to identify catalysts to invest in situations like that?
Well, Warren, you obviously have an investment thesis, so you're looking for markers that you're sort of watching to see whether that investment thesis is coming through. So in that way, one could say that those are your catalysts. But, you know, the value investment philosophy is about finding those misvaluations, which are often sentiment-driven. It's often negative news, which causes the undervaluation, and then accepting the reality that more times than not, that misvaluation will be corrected over time. So if you look at Anglo American or Amplats, for example, it really is about the capital cycle. It's a very cyclical business, of course, and those businesses are going through a normal capital cycle adjustment where, you know, when there was a lot of excess supply in the market, the resource prices dropped. As a result, a lot of the smaller businesses became uneconomical. Capital's extracted from the industry. That causes supply to contract. That causes the prices to readjust. And so the businesses which have the dominant position thus become economical once more. And so it's a long-term view where you're saying there's short-term negative news, but looking through that cycle, this will come right eventually. And you know what makes us, we find quite interesting is the fact that Amplats, for example, at the height of the platinum boom, the market was prepared to pay for the very same business a 75% higher share price. And in fact, we were being criticized for not holding Amplats at the time, or Anglo American for that matter. And of course, they both plummeted by 75% during the financial crisis. Today, we're being asked a lot of questions about why we're holding those very same stocks when they're in fact 75% cheaper.
Linda, Telkom is a share I think that you used to have, and as it's fallen out of the top 40, so it's fallen out of your top holdings. There are two views on Telkom. The one is that there's value to be had because down the line it's going to come back somehow. The other is, to use the quote of one of the guys who came in the studio, it's doomed. So there's no point in buying it cheap because it's just going to get cheaper.
Yeah, unfortunately, we have to hold our hands up and say we made a mistake with Telkom. It is a lower quality company, and we always restrict the position size of those investments. And unfortunately, you are going to make mistakes along the line. Telkom, unfortunately, we had put in a lot of negative assumptions, but those proved not to be negative enough, and we actually have sold out of the stock. Unfortunately, that is one where, even being pessimistic, we thought that the market had oversold the stock. It turns out that we weren't pessimistic enough ourselves.
Can I ask you what you sold it at?
We actually sold it fairly recently, sort of around the 16 mark.
Warren, any further points?
Yeah, just obviously it's always a tough one, but trying to distinguish between intrinsic value and a quality company that's just having a superficial adjustment to its prices, and something that's where the intrinsic value is actually declining. So I think if there's just one or two pointers, I'd like to know, in terms of the resource companies, the difference between perhaps a BHP and an Anglo at this point. Is one's intrinsic value going up, or is Anglo American just suffering from something that's going to be quite superficial in nature?
Well, the Anglo-American investment thesis is predominantly centered around the platinum side of the business. And obviously, with a company like BHP Billiton, one has to really do the analysis on each of the various components. And obviously, they're exposed to elements in the resource cycle which are actually very overpriced at that point in time. So it really comes down to the discount to fair value. And we don't see much of a discount with BHP Billiton. We're keeping an eye on it. Whereas with Anglo-American, especially with the look-through on the Amplat side, we see value there today.